After watching this video, you'll understand what a shareholder loan is, how to use it in your business, and also some tax issues that you'll want to avoid. So all that and nothing else coming up. Hey everybody, Joe here from Avalon Accounting, and today we're talking about shareholder loans. So what we're going to cover today is number one, what is a shareholder loan? And maybe you've heard of a due to from balance. We're going to cover that as well. So number two, we're going to talk about when to use a shareholder loan in your business and when not to. And number three, we're going to talk about potential tax issues and how to avoid them. So let's jump in. All right, so what is a shareholder loan? So let's jump into it. At its most simple level, the shareholder loan is the money that you've lent to the company, and the company owes you that money back. So it will be recorded as a due to you shareholder loan that's due to the shareholder. But where things get a little more complicated is when you have borrowed money from the company or withdrawn money from the company, and that balance gets whittled down, and now actually you owe the company some money. So that's where you hear the term due to from shareholder, is that it can be due to you or due from you, depending on what your balance is sitting at any given time. All right, so now that we know what a shareholder loan is, let's go through some examples of when your shareholder loan balance would be impacted and how that might show up on the financial statements. So the number one reason your shareholder loan balance would be impacted is at the start of your business. You've injected some funds into your company, and now the company owes you that money back. So that would be called a shareholder loan and would be a liability for the company to pay you back at a future date. And so that's the number one reason, and we see that all the time. The other reason on the flip side is that you've withdrawn money from the company, so you've pulled out funds. Maybe you're thinking those are a dividend, but in the meantime, they're usually held within the shareholder loan balance, either reducing the amount that the company owes you or becoming a due from shareholder and be a receivable on the balance sheet side for the company. So those are the two big reasons, but there are others. So number one is if you're buying personal items with your company credit card or company bank account. So this is going to affect what your shareholder loan balance is at any given time until you pay that personal expense back to the company. The other reason is that maybe you've paid for business expenses with your personal bank accounts, maybe by accident, maybe on purpose, but essentially what you're doing is lending the company money, and that's going to be a liability. The company owes you that money back to cover that expense. So as you can see, you can be using the shareholder loan balance without even knowing it. So your accountant or bookkeeper may be recording these personal transactions or money you've spent personally on the corporation's behalf to this shareholder loan balance, and it might fluctuate from a shareholder due to or a due from, depending on what the situation is at any given time and how much you've either borrowed from the company or lent to the company. So that's just important to keep in mind. All right, so next up, we're going to talk about the potential tax issues with your shareholder loan balance and how to avoid them. So the reason you're going to get in trouble with your shareholder loan balance is if you've taken money out of the company, you owe that money back to the corporation, but you have not claimed that as personal tax income. And now that makes sense, right? You've pulled money out of the company, not claimed it as income. CRA doesn't like that. So to make matters worse is that you will have to claim that money as personal tax income, and the corporation actually doesn't get a deduction for that amount. Now that amounts to double taxation, and it's something we really want to avoid. So the ways to avoid that are to repay that loan balance is the number one way to do it. But the number two and number three ways are to claim that as wages or claim that as a dividend. So you've pulled money out of the company, and we need to claim that as your personal tax income. All right, so now we understand how to avoid that tax issue, that double taxation issue, by either paying back the loan, taking that income as dividend income, or taking that as salary income. So you may have thought of a couple scenarios where, hey, I think I could work myself around this. I think there's some opportunity to borrow from my company and not claim that as income. Well, the CRA usually has you covered on that. So we'll go through a couple scenarios where people think they have the system beat, but those loopholes have been closed and there's rules against doing that. So the number one way people like to think they can get around it is, take out that loan, but just before year end, just before you are ready to report your balance sheet, you pay back that loan, and then maybe 2 or 3 days later, pull that loan out again so the CRA doesn't know about it. Now that's really a bad thing. The CRA has you covered on that side. You're not allowed to take out a series of loans from your corporation without calling that personal tax income. So they kind of got you covered there. The next one, and this is a really legitimate thing, I believe, is that you borrow money from the company and you promise as a person to pay back that money with interest like any company would do. Unfortunately, the CRA has you covered here as well, and you're not allowed to borrow from your corporation, even with interest, on account of your ownership. It must be done on account of your employment. And now that's a really tricky thing because the CRA determines that your employment status would be, what you've offered to other employees, that it's a blanket policy that you lend, down payments for mortgages to all of your employees. And that's a really difficult thing to prove. So generally we don't see it. We don't see people borrowing from their corporation. You're pulling that money out as dividend income or salary, and we really avoid carrying loan balances for more than 1 year. All right, guys, that's shareholder loans in a nutshell. We've covered what it is, how to use them, when not to use them, and tax issues that can pop up. If you know of any loopholes, please post them in the comments below. We'd love to see what you're coming up with, and maybe ones that are open, ones that are closed. Happy to hear about all of those. And like and subscribe. We'd love to see you around the channel putting out more and more content for small business owners just like you. So please hit that subscribe button. We'd love to see you around the channel. Cheers and have a good one.